Hello and welcome to Trade Finance Talks. I'm Mark Abrams, Director at Trade Finance Global. Welcome back to the third of TFG and Standard Chartered's 5-episode podcast series, Future of Trade. This episode discusses commodity trade finance, which, as the name suggests, involves the financing of the physical trade in commodities. It could involve the actual financing to bridge the purchase of commodity, or could be structured as an instrument, the most common of which is a letter of credit. Dealing with all things physical trade, CTF is also one of the most impacted and impactful topics we encounter, with tangible repercussions ranging from oil in the Middle East to digital advancement in Silicon Valley and beyond. I'm joined today by Clemence Avril, Global Head of Commodity Trade Finance at Standard Chartered, to discuss the opportunities which CTF solutions could bring. Clemence, welcome to Trade Finance Talks.
Thanks, Mark. Happy to be here.
Please, could you introduce yourself and tell me about your role within Standard Chartered?
So I'm Clemence Avril. I'm leading commodity trade finance for Standard Chartered. I've been in Standard Chartered for 3 years now, and prior to that, I was always on the commodity trade finance side in other bank institution. I've done most of my career in Asia. I've been 18 years in Singapore now, which is a big commodity hub. So today, what do we look at? Commodity trade finance, it's a specialized unit which focuses on trade products granted to a specific client segment. So that's the commodity traders, and it's the wider range of the commodity ecosystem. So commodity traders, but also the sourcing arms and the trading arms of the oil and gas companies and the metals and mining, without forgetting the agri players. So we try to have an industry lens and specialization. It's a sector that has been through a lot of changes, a lot of shifts, a lot of frauds, and unfortunately, things like that. With having a specialized unit, we try to build a robust franchise so we can continue to accompany our clients and have potentially bespoke solutions tailor-made for them and help them grow their activity.
And probably one of the areas you really need a specialist, because those changes we're seeing more and more, just as we were talking about before. And so what are some of the macro trends you're seeing from clients, and how has your financing strategy evolved in response?
On the macro side, we've just seen the end of a super cycle. We've had post-COVID, we had supply dislocation. There was the Russia-Ukraine war. Last year and the beginning of this year have seen more of a normalization phases. So for client, what does that mean? Lower price volatility versus 2022 peaks. We've seen tighter margins. One of the key things that have come up is there's a lot more disciplined working capital management from our clients. Our clients are more balance sheet aware. They're trying to diversify their funding pools. And so the clients are becoming increasingly sophisticated, both in their trade asks and in their treasury needs. I give you an example. So clients are really mindful about their balance sheet today. So they are looking for structure which can help their trade levels. On our side, we're trying to increase our supply chain finance offer through receivable purchase, through supplier finance. With insurance wrap, we're looking at portfolio pool-based receivable purchase. But as an institution as well, we can provide solutions such as inventory finance or securitization, et cetera, to help the clients in that balance sheet management. In terms of funding pools, we've seen a lot of new players has come beyond the banking organization. We've seen private equity. We've seen private debt. We've seen funds set up trade finance teams in order to try and bring further liquidity to the players beyond the banking pool.
And we've seen the same, and I completely echo the level of sophistication and kind of enhancement from treasury teams. But I guess even with those new entrants in, as you were saying, it's not just bilateral self-liquidating trade facilities now that basically these companies are seeking. As they increase their level of sophistication, they're looking at the expertise that you have, and diversification is key. And if we actually dig into it a little bit deeper, what commodities are you most involved in at the moment?
So I'd say the three main buckets. You have everything that's oil and gas related. So it can go from the whole chain of upstream, midstream, downstream. So crude oil, refined products, LNG, LPG, etc. Anything that's metals and mining. So that's the whole range from ferrous metals, iron ore, steel products, or base metals, anything that's non-ferrous, as well as the agri world.
And actually, if we actually dig into just in terms of time bound, so in the past years, and what disruptions of commodity supply chains experienced? So there are many, but what kind of would you dig into?
Maybe before I go to last year's disruption, I thought it would be good to share a little bit about how the market has evolved over the 4 to 5 years. The market had shifted before last year's disruption in any case. We have seen a lot of consolidation among the trader space and a lot of exit of smaller players. So the market has become more consolidated. The commodity traders have become bigger. Now we've seen arrival of new players. Now, these new players are not new globally, but they're new in the commodity trading world. I'm thinking about the national oil companies of Middle East, which have all set up trading arms. I'm thinking of some other integrated groups that have set up their trading arms in Hong Kong or in Singapore in order to capture their volumes. What we have seen as well is we have seen some corridor shifts. So, for example, we have seen American oil players setting up trading arms east in Singapore, in China. We have seen the Chinese trading arms of oil national companies setting up offices in Dubai, in London, in New York. All of this globalization, everybody wants to capture the supply chain. Those are some of the key trends over the last 4 or 5 years. In the agri-space, we've seen the entrance of some government funds for critical supply management. So we've seen some funds in Middle East go into big agri-traders and take some equity stake into that. So all of this has changed a little bit of how the market was operating over the last 4 or 5 years. Now, last year was quite disruptive. We've seen geopolitical risks. We've seen the Ukraine-Russia war. We've seen sanction on the Russian oil. We've seen the trade tension between China and the US. We've seen tension in Middle East and situation escalating there. So all of this is quite a fluid situation. Because of all that, we've seen more rerouting of cargoes. Cargoes that can't go through the Panama Canal, that can't go through the Strait of Hormuz. Higher compliance costs for the companies. When the EU says that anything with a Russian nexus cannot come into EU when it's a product, how do you know that the product you're buying from this refinery doesn't have a Russian element? It's very difficult for the companies to take that into consideration. We've seen shipping and transit disruptions, longer bottlenecks, freight cost has gone through the roof. So all of this has been quite a difficult trading environment last year, but that also creates volatility and opportunity for traders that actually like arbitrage.
And actually, if we pick up on that, or we stay where we are in terms of, you touched on macro issues, refineries actually building out, controlling the supply chains and having their own trading arms, consolidation generally, but also within those, I guess, consolidated players that you're mostly banking or working with, that diversification in terms of funding pools. So if we actually look at some of the smaller, but to those larger, and we've already touched on it, but how do they build resilience? So what are you seeing in the market? And what would you effectively advise, and how is that going to evolve?
They keep evolving. And one thing that comes out is, if you think about the original commodity trade finance play, I'm doing a very caricatural statement here, but it was a guy with a phone that knew somebody at the origin and knew somebody at discharge, and that would do the connection between supply and demand. And that's the original of trading and commodity trader in the 70s. And then they needed a bank to finance that because it was a lot of working capital needs. Today, the old model of single origin, single commodity, shortest route, low freight, at least it's gone for the foreseeable future. And so traders, in order to build resilience, they need to have different options. They need to have more than one origin. They need to be set up in different jurisdictions so that they can avoid any sanction risk or any, change in legal environment. They need to diversify their trading routes. And if we think about it, supply has become key. And we are seeing increasingly traders going a little bit more up in the value chain, trying to take equity stakes in offshore fields, in oil fields, in mines, et cetera, to be able to fix their supply. We've also seen some traders that was specialized in a certain commodity expand to new commodities. We've seen oil players expand into metals because the EV battery chain is now key. So everybody wants to be part of the EV battery chain. So people are investing in cobalt and lithium and other things like that. And diversification helps them build resilience. They have regional treasury centers or trade centers in Singapore. They have it in Dubai. They have it in Geneva. And they get more funding from different pool of banks and different pool of investors. That will continue over the coming years.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
So really diversification, not just in funding pools, but also in products, is what you're seeing, what we're seeing. And then if we actually look at I know macro is very much relevant today, but actually if we look at just trade and documentary, if we look at digitalization, how's that changing the industry and commodities?
I'm a strong believer that digitization will change the industry. We are trying to use digital platforms, for data simplification, to improve resilience, help to simplify client journey. However, the issue is really the adoption rate. Digitization only works if you can have multi-party adopt the same standards. That's your supplier, that's your buyer, that's your freight forwarder, that's your vessel owner, etc., etc. It's been a journey for 20 years. There have been various actors throughout the years that have had a digitization offer, a blockchain offer, etc., etc. But before it can be totally widespread to that environment, and that's beyond commodity trade finance, that's for all trade, there's going to be a regulatory and a legal alignment to be done in the various markets. Because until that's done, it's going to be very pockets of adoption here and there, and it's not going to be very widespread. I remember I worked on the first blockchain LC transaction with an actor that doesn't exist anymore, but we did the first LC blockchain, and it included an electronic BL, which is something that's been around for years as well. But when the cargo reached China, the electronic BL had to be switched to a paper BL because the client couldn't clear custom in China. So it was some years back, but that example can still apply in a lot of jurisdictions, so it's going to take a bit of time.
And actually, I liked how you touched on the kind of going all the way back to a guy on a phone trading a commodity all the way through to today, where your diversification and supply chains. If we look at that digitalization in relation to fraud, and I'm always personally, I guess, underwhelmed whenever I hear about these frauds because it always seems to be the same thing over and over again. I guess if we look at digitalization, is there a way is it helping? Is there a tool or does it provide more threats? What are your thoughts?
Okay, fraud can come in various forms and ideas, to be fair. We've had, in the industry, fake BLs, fake warehouse financing, oil that was supposed to be in tank but wasn't there because people had just put some kind of tube in it, and when the surveyor came, they thought the oil was there but the rest of the tank was empty. Double financing, balance sheet fraud. So there's been a lot of stories throughout the years in the commodity space, which is quite unfortunate, but it is what it is. If we start using digital blockchain technology, I think that the risk of paper forgery will be reduced. It will be instant, it will go faster, there'll be more visibility, it can be traceable. So that should help. I mean, it's going to be digital, right? And like any digital tool, you're going to face the risks that are linked to digital fraud, cyber fraud, system manipulation, impersonification, and things like that. And that's why it's going to be very important, at least as a bank, as an institution, to have robust fraud capabilities on the digital side as well. Everybody wants to do things faster, cheaper, and with more visibility and more clarity on what's going where.
And I guess that's the point, right? If we look at we see kind of from cost cuts to head cuts to with AI coming in, if we just touch on AI in relation to fraud detection and how that would be actually helpful, you also need that human element to detect, is something real or is it not real? And then if we actually move on to, I guess, in terms of funding, diversification of funding, resilience of the groups that you're working with, and especially the treasury teams, where could actually stable coins and digital assets fit into the ecosystem that you're in?
As an institution, we see digital assets and digital currencies as a permanent part of the future of the financial system. Our institution is a big believer that stablecoin will have a seat at the table for any payments going forward. In the trading business, it is important for things to go fast. You have a cargo loading, you have goods that are being on the vessel, and these payments have to happen sometimes over the weekend to avoid demurrage costs, etc., etc. Having the possibility to effect payment through stablecoins, which is a digital currency, which is not bound by the physical market of, US dollar being open, etc., is definitely something that will help our clients to improve their trade activities and their funding needs, because they can pay on a Saturday, they can pay on a Sunday and avoid costs. Stablecoins will be a feature in the near future or in the medium future. It will be another element that clients can use as a funding or a payment means for their trade activities. Now, digital assets is currently being looked at, I know, by some of our customers, notably in terms of, could I have a token as a security? Could I have a digital token which constitutes, so can my cargo be tokenized? Can my bill of lading be tokenized? Can my contract with this supplier or this supplier actually become a smart contract that I can tokenize and with that try and get funding against it? We go back to what I was saying about digitization, it's all going to go down to legal environment, regulation, and adoption. Because if you want to take digital asset as a security over your financing, you need to be able to enforce that digital assets. And that enforcement is not tested. There's not a lot of countries which have that regulation to recognize it. And I think it's going to take some time, but I hope that we will see an adoption of those types of financing in the future.
We've talked about a number of different technologies. So what do you see as the biggest external factors which are driving innovation going forward within CTF?
I mean, we've talked about innovation, we've talked about technology. What's really going to be important for CTF in the coming years is the geopolitical situation. That unrest on the geopolitical side is going to be key. As I said, traders are going to have to be even more nimble in sourcing new trade corridors. With new trade corridors, they might need new trade risk structures. The banks are going to have to adapt. Are we going to see an explosion of prepayment needs in different countries because that's where the minerals will be? So all that shift of geopolitical changes, which unfortunately keep happening over the last couple of months and years, is still going to be something that's going to be key for the commodity traders to be able to expand their business and grow it in a sustainable manner. And as a bank, we will have to continue to be innovative in terms of our risk appetite, in terms of our structures, in terms of where do we accompany our clients so that they can keep bringing commodities throughout the world. Because at the end of the day, people need oil. People need metals. It's part and parcel of what we use every day in our day-to-day life. So it's very important that ecosystem of commodity traders continue to be equipped and be funded by financial institutions so that it can bring consumer goods to the end buyers like you and me.
Just leaving you there, but asking one last point. I mean, imagine a world that all of these innovations that we're talking about have happened. How are you seeing the groups that you're working with actually navigating the macro uncertainty that we're seeing? Where do you see the market going? What are you seeing your clients doing? And also, how does one look to the future world, all the uncertainty that we're seeing with the changes in the last few weeks?
Commodity traders thrive in uncertainty. I mean, that's how they make their margins, and that's how they have adapted to a few oil shocks. They've adapted to a few trade wars. They will continue to be nimble. They will continue to be close to the ground, and they have connections in the countries where they operate with. So they will navigate all this uncertainty well. The consolidation will continue. Over the years, things have kept shifting and they're still there. So I'm quite confident that they will be able to thrive even with the uncertainties that we're seeing today.
And I tend to agree. From someone just being on the phone to someone that they know and finding from a straight flow shift to diversified product bases now, being nimble and close to the ground is kind of through the veins of commodity trading. So really appreciate you coming on today. And Clemence, thank you very much. Let's hopefully speak soon.
Thank you.